let's start with our first panel discussion on the subject of the edge of asset allocation. Well, the edge of asset allocation is the theme of our first panel discussion. So let me just give you the broad strokes first of all. Our investing journeys are long and they also keep evolving with numerous plot points. Now, investment recipes have to be changed in accordance with changes in risk taking capacities and goals due to the uncertainties in life. Now, asset allocation is the ritual that can see you through periods of our turmoil and is considered a touchstone of a successful investment journey. Now, the underlying idea here is that by apportioning your capital in a wide variety of asset classes, there is little concentration of risk in your portfolio. And should one of the asset classes perform poorly, the effect can be absorbed by other asset classes. Now, despite experts reminding the investor community time and again of the importance of diversification, many of us are guilty of overlooking it. Now, even the most disciplined investors, they fall prey to biases and let diversification fall by the wayside when managing their investments. So, our first segment is going to highlight the importance of edge, the four asset classes of equity, debt, gold, and real estate, and the correlation between them, and how you maintain the right diversification in your portfolio with these assets. So, let me quickly introduce our stellar lineup of speakers who will share their insights on the topic. Joining us on this panel are Piyush Gupta, Director, Funds Research at CRISIL. We also have with us Dhirendra Kumar, founder and chief executive at Value Research. Also with us is Gurmeet Singh Chadha, managing partner and chief investment officer at Complete Circle Wealth. And last but definitely not the least, Vinod Bhatt, portfolio manager and head of knowledge management equity at Aditya Birla Sun Life AMC Limited. Welcome to the show, gentlemen, and thank you so much for joining us. As investors who are watching this show, we're all looking forward to hearing your thoughts and insights on this very topic. As Mr. Rao mentioned, an empowered investor is a protected investor. An educated investor is a protected investor. So, Piyush, let's start with you. Let's start the session by asking you to elaborate on the four major asset classes that I mentioned earlier and the role that each of them can play in an investor's portfolio.
Right. Thanks, Gautam, for having me here. First, let's look at the asset allocation. What is asset allocation? Asset allocation is a process of building a portfolio with different asset classes, which have different risk profile. Uh, it's if I were to explain it with the help of an analogy, a cricket team which is built by a captain, he looks at different players with different skill sets so that they can come into play with the changing pitch condition or match condition. When you're building a investment portfolio, uh, you have dynamic market conditions. Markets can change due to multiple factors. There are times when equity market go through a good phase, but there are also corrections in the interim period, and hence there is a need for multiple asset classes which can play their role given their individual risk return profile. For example, equity as an asset class is a growth asset class which builds wealth over a longer term. However, it has volatility in the shorter term. So when one take exposure to this asset class, it's important to keep investment horizon in mind. Having said that, there are ways and means to mitigate volatility in the portfolio by adding different asset classes. Second asset class being debt, which provides stability to the investor's portfolio. In a time when there are correction in the equity market, a portfolio which is 100% equity versus a portfolio with a say 50-50 allocation to equity and debt, the second portfolio is likely to do much better compared to a 100% equity portfolio. Debt as an asset class is also an asset class which provides investment options to generate regular income. So, if there is an investor which has a need for regular income during the course of his financial journey, debt as an asset class can provide that regular income that he may need. Beyond equity and debt, we have asset classes like commodity. Within commodity, gold is something which is used as a common medium for investment, especially by Indians. Now, gold as an asset class, if we were to look at historical risk return behavior, we find that it moves in a direction which is opposite to other asset classes. For example, in 2008, when we had global financial crisis, equity markets correcting almost 52%, that was the time when gold gave 25% return in that particular year. So, uh, and markets are dynamic, so you will have these volatilities during the course of financial journey, and gold as an asset class can provide that diversification benefit when you are building a multi-asset portfolio. Similarly, you have real estate as the alternate option. However, it's an option which is expensive in nature. One has to shell out a large sum of money to take exposure to this asset class. Over a long period of time, this is an asset class which is expected to generate return superior to inflation. However, this is an asset class which also requires large sum of money for one to take exposure directly. So, in a nutshell, by constructing a portfolio of multiple asset classes, one can traverse through the different volatilities that one can go through during the course of time, and also provide stability to the overall portfolio.
Well, I like the explanation that you gave in the frame of reference of a cricket team, right? At the end of the day, a cricket team is balanced. It's got its mix of heavy hitters. It's got its middle order which stabilizes the innings, and it's got the tail ending which sometimes can come up with fantastic, unpredictable performances. And at the end of the day, that's what the game of investment is. You have to pair it with your goal, and you have to have different assets which suit those goals and make sure that you at the end of the day can achieve all of your objectives and move forward in your investment journey. Thank you so much for that, Piyush. Dhirendra, if you can hear me, just to take us through the correlation between the four asset classes that has been mentioned and the benefits that it holds for investors, if you can outline it for us, if you can hear me loud and clear.
Yeah, now I can hear you, though I don't have the privilege of the context, and I couldn't hear what was being talked before.
So this is
But
about the four asset classes, about equity, debt, gold, and real estate. That's the edge of asset allocation, as we are calling it in this panel
yeah,
discussion. So the correlation between these four asset classes and the benefits that you see holding for investors.
yeah, there is a great benefit. One must many a time, Indian investors have been binary. They have been either an equity investor at a given point, and when they get disenchanted, they become a fixed income investor. And gold and real estate has emerged as an asset class in a financial form in recent years. But I don't look at them as I look at it, they are an asset class. But I don't think it is wise for most investors, because the way we look at real estate, having a home is good enough. And for most individual investors, real estate as an asset class is still in the very basic stage of evolution, in a state of infancy, with REITs and other things evolving. And it's because it's a big ticket investment. It's a leveraged one. It has a lot of it has great risk. You can't diversify well. So with that in mind, and gold, as you know, that you can buy gold, but I haven't come across anybody selling it, and it's more of a consumption. It's a jewelry. It's a It is it's the oldest asset form which has been able to preserve its worth. Uh, but is it an inflation beating one? No. But equity and debt is widely available, widely used, is in the financial form and of all grades in terms of safety, security, liquidity, tax efficiency. So I think, and these two asset classes are good enough and big enough for anybody to allocate meaningfully. I think the primary objective of asset allocation is to. Many people think that many times people think that it is return maximization mechanism. No, it is actually a regret minimization mechanism because good times everybody is excited and that is the psychology. Nobody wants to everybody wants to leverage that and ride it. And the downside, everybody is so disappointed that you walk out in a half at the most inopportune time. So asset allocation comes in handy. You and also it enables you, it provides you a mechanism that you can participate. You can, the easiest way of making money in market is to buy low and sell high, and most individual investors end up doing the opposite. And the way to deal with it, to have the mechanism, have the wherewithal to be able to invest when it is low and to be able to get out of things when it is high in a methodical manner is asset allocation. You do your asset because nothing is in your control. You can't anticipate things. You don't know all the moving parts, and there are just too many moving parts added to the market in the last 5-10 years with the globalization, many other things. What you have in control is your allocation, your time frame, and you don't really need to go and ask anybody. So asset allocation comes in handy if you are a disciplined investor, and if you are able to do it well and able to enforce it for yourself with just equity and debt, you can do it.
Absolutely. As you mentioned, with so many moving parts in the market, it's important for investors to view asset allocation not as a returns maximization mechanism, but a regret minimization mechanism. And that's the headline coming from Dhiredran. Speaking of regret minimization, the factor of risk comes into play. So, Gurmeet, let me bring you in because in the Indian investment landscape, the word risk has been assigned many negative connotations. So, what are the biggest myths pertaining to risk in the gamut of investments that you would like to debunk on this platform?
Yeah, thank you. And I think it's a very relevant one. And just spoke about risk-adjusted returns. I think the first myth about risk is that real estate and gold is safe, and equities are riskier. Right? I think it's a great myth. So people who are living in Bombay will tell you that for 8 years the prices of real estate haven't moved, and then there is a risk of liquidating it. Right? You might be just stuck in it for very long periods of time. Gold before this interest rate cycle began had a very prolonged period of flat to negative return. Similarly, the second risk is that equity, you need to be an expert, you need to time the market, and it's very speculative in nature. On the contrary, if you look at it, if you're not an expert, let's say, and you've been only buying the index, right, for last, let's say, 10 years, right, just on a monthly basis, quarterly basis, the 1 year return is in this environment is upwards of 11%, the 3 year is 18%, the 5 year return is 15%, the 10 year return is about 13%. Right. So even if you don't know anything and you've been simply, playing the India story, just buying the Nifty, just every single month, you beating every other, asset class by a decent enough margin. The other myth about risk is that bonds are safe, and you can buy them, and fixed income means fixed returns. I think this is another myth, right? So if you speak to your friends in US, they will tell you how badly they have lost in last 1 year. In fixed income, most of the bond funds would have given negative returns. So my thing on here is that we have this patterns which we live with, and we make interpretations around it. I think that's where the role of allocating assets come into play, and the fact you have to first also tell yourself the returns are non-linear. So Nifty giving 13% in last 20 years, there have been only 3 years where it has given 13%. Most of the years it's way above that or way below that, right? So I think that's the first thing you have to tell, that asset classes returns may not be linear. In fact, most cases they are not linear. And that's where you figure out that, okay, I need to have a better time horizon for that. Second is the myth that you can timing is extremely important in the market. Somebody released a SIP data, I think it was White Oak, if I'm not wrong. So if you did a SIP on the first of every month, and if you did a SIP on the best, which is the lowest point of the market every month, and you did a SIP at the highest point of the market every month, the return was from 14 to 14.6%. It did not matter in 20 years at what point of time. So people often ask, what is a good time to start? Is it too risky to start? Right? The biggest risk is not being in the market over long run. Now, let's say you were doing a fixed deposit for last 20 years. You were reviewing it every year, right? Without fail for 20 years, right? The 1 lakh, let's say you did a fixed deposit. In 20 years, it would be 4 lakh rupees at 7.2%. I've taken all average interest rates of last 20 years, taking SBI as the benchmark. So if you're very diligent and just renewed FD every year, for last 20 years, the 1 lakh is 4 lakhs. Had you just done that on the Nifty, it's slightly more than 16 lakhs, right? So that's the difference. You have. So that's why I said in the long run, the biggest risk is not being in assets which generate returns more than inflation, and thinking that, okay, real estate is safe, gold is safe, others are riskier. So have a bigger perspective, and if you don't want to do anything, just keep it simple in investing.
Well, that's the idea. Keep it simple, especially when we hear so many inputs coming in on how one should approach their investment journey. As you mentioned, timing the market, of course, is always playing out in the minds of investors. Something maybe they could time their SIPs in a way that they maximize their returns. But as you have outlined, Gurmeet, at the end of the day, you have to be part of the investment story. The timing doesn't matter. Once you're part of the investment story, you can watch it grow. And the other aspect that you mentioned, Gurmeet, around gold, that's something I want to bring in Vinod, because I myself, when I went to check the price of of gold, I was very surprised. The last time I checked, it was less than half the price. So somewhere along the way, as someone who invests in mutual funds, I would suddenly start thinking about gold, saying, oh, I didn't know this was such a great investment class, or so on and so forth. But of course, the reality is something else. You have better asset classes to look at as well. So Vinod, let me bring you in on this, on your take on this fascination that Indians hold for gold. Do you think that the conviction in gold that needs to change right now? If you can unmute yourself, I believe you got yourself on mute.
Yeah. Yes, if we look at the household allocation data in India, we'll see that around 50% is to real estate, 15% is to gold, another 15% is to FDs, and less than 5% is to equities. This is very well-known data, and I do believe it because in my own family, I know that this holds. I have people in my extended family who have invested only in FDs or only in gold and only in real estate, right? And if we look at the returns for the past 10 years, so real estate has only given 3 to 4% CAGR returns. Gold has given only around 4 to 5%. Fixed income is more stable, about 7.5%. And equity, as we all know, has given around 12 to 13% CAGR return, right? So while gold, it seems like forms a part of the core portfolio for most of the Indian households, the returns over the past decade have been very low, only 4 to 5%. It's only because, during 2020, the COVID period, gold gave 30% return that year, and hence the near term, like the last 5 year returns, right? So we need to understand what, if you look at equities, for example, it is an asset class that is suitable for long-term wealth creation, and fixed income provides stability to our portfolio. So in that sense, gold is more of a hedge. So what does it provide a hedge for? So one is regarding any kind of geopolitical uncertainty like the Russia-Ukraine war, or any kind of unexpected events like the COVID pandemic or extremely high inflation, right? So these are the events when gold stands out, whereas on a normalized basis, gold will not really give very good returns, right? So that is the perspective to keep in mind when we invest in gold, and hence our recommendation is that the bulk of an investor's portfolio should be to equities for long-term wealth creation. There should be allocation to fixed income for providing stability to the portfolio. And maybe we can consider a 5 to 15% allocation to gold as a hedge against all the items that I mentioned, right? So that is the a good way to look at it. And what is the best way to get exposure to gold? Now, typically in our families, we know that we buy physical gold, but then there are problems about storing it. We don't know the purity, right? So the easier way is to invest in gold ETFs or in sovereign gold bonds. There are no issues about the purity or about storage, and the liquidity is also very high. Right? We can buy and sell them as and when we want. So I think that is the right perspective to keep in terms of having gold as an asset class in our portfolio.
All right, a message to note there for our viewers: approach gold as a hedge rather than a primary sort of asset allocation a measure. And of course, you have options like sovereign gold bonds available to your gold ETFs, as Vinod has mentioned, if you want to explore that as an option. All right, bringing all these points together and looking at it from the relevance of investing audience watching, Piyush, what are the boxes that investors need to check when deciding their asset allocation between equity, debt, gold, and real estate? As Dhirendra mentioned, approaching asset allocation as a risk minimization mechanism versus, say, a returns maximization mechanism. How can investors achieve that balance, Piyush?
Yeah. So I think asset allocation is an important step in the overall financial planning exercise. And there, the first step is to define the objectives, both in terms of return as well as risk. Return objectives will get defined basis the goals that the investor lists down as part of his financial journey. And there again, it's important to classify them based on their priority or importance when he's planning for his portfolio. Uh, the goals when an investor identifies the goals, it also in a way indicates the kind of investment horizon he has for his financial goals. So in a way, when you define your return objective, when you define your goal, you get to know what is the amount of corpus you need to build for your financial goals. The second point that needs to be defined is the risk objective. Now, in case of risk, as an investor, people have different level of risk-taking ability. Uh, it is also the willingness that comes into picture. It's not just the ability, but there are some people who might be able to take higher risk, but they may not be able to withstand huge amount of volatility in their portfolio, and hence it's important to define the risk level as part of their portfolio. Uh, Beyond this, investment horizon, along with the liquidity needs that the investor may have during the course of time, is critical while an investor is building his portfolio. Now, all of this put together will, in a way, determine the kind of allocation you may want to have across different asset classes. An investor with a long term investment horizon who's possibly starting his career and he's able to save more and can increase his saving over a period of time, maybe a higher allocation to equity in the initial period may be beneficial. An investor who's looking for a regular income, asset classes which provide regular income, or the options within those asset classes which provide regular income needs to be part of the portfolio. So all of these components need to be looked into before building a overall portfolio for himself.
All right, that's the investor checklist. Dhirendra, to bring you into the conversation to add to this, how should investors choose between different asset classes, especially for different goals that Piyush had outlined?
No, that is all the academic bit. That this is how they should be doing. This is how they should not, what they should not be doing. But I think the practical part of investors' journey is that initially investors are attracted by the return, and they're scared by the decline in steep decline in a brief period of market, in a brief period of the market. And as it is being said, that you have to acclimatize yourself. It is like going on a long journey. And for that, because the market's behavior, the character, the design of it is not going to change. It has been like this, and it will remain like that in future, in times to come. So market goes by the staircase and comes, comes by the lift, by the elevator. So, in that sense, that will always be scary for the new investor. For investors to get started, and there are broadly three phases of an investor. If you're in, you start early. It is very important to start in a manner that you develop a belief. After 2-3 years, you can be an all equity investor while you are in the accumulation phase. And then comes the phase when your accumulation, you depend on that for drawing income from it. And this is broadly, and you need to follow few principles, which is diversify, allocate once your accumulation becomes meaningful, and be at it, not get tempted, because most of the time investing is all about what not to do, the 50 things which you should not be doing, getting attracted by the past performance, getting attracted by the hottest thing that is happening in the market. These practical things, if that is embedded in the advice framework of any advisor, or an investor buys into all this and develops a belief, and that belief, there is one thing which I can assure you, based on my 30 years of hanging around in the market, has taught me, is that you don't learn from other people's mistake. You have to lose your own money, or you have to learn quickly based on. So earlier, the faster you learn, because if you look at what has happened from last Mahakumbh to this Mahakumbh, people got carried by crypto, they lost it, and they don't have a hope. People got attracted to the IPOs, and they have lost 70% of their capital, and some of them are hanging around, some of them are looking at it as an opportunity. People get attracted, opportunistic investor, and that is the story. That is what the market is made up of. You need to frame your own plan, and that plan has to be rooted in your behavior, your temperament, your learnings, your time frame. And mutual funds enable you to do it with great simplicity. For somebody who is getting started, start with an aggressive hybrid fund. It might look like a very boring thing, but when the market has this steep fall in a brief period, as in March 2020, you will not get scared. You will not be driven out of the market forever. Once you have accumulation, work on your asset allocation plan, and don't overdo it. Keep it simple. Have an annual rebalancing plan, because asset allocation in itself will not help. And so doing few things, having a guide who will help you do these things or learn these things will come in very handy. Spend some time. It's your money. Nobody can worry more about it than you.
Well, some very important points to note for our investing audience. And speaking of mutual funds, there is an upcoming panel, just to give a heads up to our viewing audience, where we will discuss mutual fund trends in detail. But to take that point forward, what Dhirendran mentioned, and bringing that analogy of the cricket captain, because for a captain, while the team is also important, let's not forget the pitch and the climate, the weather is also important, and they keep changing. So Gurmeet, bringing you into the picture, how are the performances of the 4 asset classes which are linked to market cycles? And using that analogy of cricket, how should investors invest in them during different economic climates?
So, Gautam, you rightly use the analogy. You need a Pujara as well as you need a Pant and a Surya Kumar in the portfolio. So you need to defend and take advantage also. So Saurabh Ganguly used to do in-out field. He had closing positions also, and he had people on the boundary also. So you don't take the singles, you don't get the boundaries also adjusted. So I think few things which the new investors need to learn. The cycles have shortened. There was a time you had 10 years of depression, and then you had 10 years of expansion. Now look at what has happened in the last 3 years. We had depression, we had then recovery, we had hyper growth, and we are again staring at another recession now. So the cycles have shortened, and that makes the understanding of cycles and the reaction of asset classes very, very important. So one thing you have to keep in mind is that some of the asset classes will do well in a particular cycle. So in a cycle like right now, where interest rates are going up, there is inflation, assets like gold tend to do better. The gold is considered as a hedge for inflation. Gold also hedges you against a black swan event. So if you remember, the gold prices went up sharply in 2008. It also went up into when COVID happened. When things started shutting down, and it's again started now going up as inflation picks up. So some part of the allocation to gold should always be there, and it should be slightly increased if you are in a very inflationary environment. So last 5 years, at least matching equity returns right now, right? If you take it in INR terms. Secondly, your equity tends to have a negative correlation against rising rates. So last 1 year returns, if you see globally, is negative. India, for example, has still done a phenomenal job. A lot of us don't appreciate the point that if you fall less, also that itself is also one of the goal achieved. And India hasn't fallen in this last 1 year. You pick up any global market, you are down between 20 to 30%. Even in dollar terms, we are just down 5% last 1 year, which I think is a great accomplishment looking at how the withdrawals have happened. Similarly, when the economic cycle turns, and real estate also tends to benefit, hard assets tend to benefit in an inflationary environment. You've seen how the housing has picked up in few metros and class A cities already. On the contrary, when interest rates tend to go down and you have an easy interest and easy liquidity environment, equities tend to do better. But what point I'm trying to make is these cycles have suddenly become months instead of decades. That is where the balancing, which even some of my panelists made a point that it's very important to regularly review and see how are you going overweight, underweight there. The other point which also I make is that within asset classes there are cycles, right? So you had a growth and a value style debate. For long, value style was beaten, and last 1 year, look at the way value has made a comeback. So now you have to pay more reasonable valuations. One last message to investors is that you should have a strategic and a tactical asset allocation. Don't tinker too much with the strategic asset allocation, right? It could be 80-20, could be also called core and satellite. Also, there's one particular thing about Indian equities, which is the point I wanted to make. While our economic growth has been averaging about 6%, around about that, the EPS growth has been better, right? Because of the movement from unorganized to organized, in a lot of reforms which have happened. Last 10 years, I'll give you data, which is hard data of last decade. Nifty 50, if you take Nifty 500 companies, which is the larger universe, India has had 20%, 20 companies which were 10 bagger. 20% of the companies have been 10 baggers out of Nifty 500. Now, if you take this ratio with US, it's only 7% for S&P 500. It's only 3% for China. It's only 10% for NASDAQ. So India has had, 20% 10 baggers in last 10 years in Nifty, 500 vis-a-vis the NASDAQ, China. So our EPS growth, because we are in an environment, in a market which is, we have a parallel economy. There's a movement happening for, unorganized to organized. Our EPS growth tends to be better with better, recovery in the equity side of it, and we are seeing financialization of savings. So if you are a long-term investor, you have horizon on your hand, be slightly overweight India over the next decade.
All right. Believe in the India growth story and take it from a strategic perspective rather than a tactical perspective. On that note, Vinod, let me bring you in terms of strategy. What, according to you, is the best strategy for long-term investments amid volatility? And I believe you've authored a book titled The Financial Independence Marathon. So looking at it from a marathon perspective, where you've written about how, say, asset allocation is the best strategy to follow for long-term investment to achieve financial independence. Take us through the details.
Sure. Yes, Gautam, actually, the motivation came from my family. As I mentioned, in my extended family, there are folks who have been investing only in FDs or only in real estate for the past couple of decades. And on the other hand, there are folks who are trading directly in stocks and FNO and have also speculated in crypto. And based on my discussions with them, I realized that for all the efforts that are being put in, the financial awareness is still quite low. And that motivated me to write this book. It's called The Financial Independence Marathon. And what I've done is I've tried to explain in a very simple, entertaining, and in a novel format the journey of financial independence for an investor and brought it out as an analogy to running a marathon. So what I've done, I've explained the basics of various asset classes, whether it's FDs, gold, real estate, or stocks and bonds, mutual funds, passive funds, as well as crypto, NFTs, blockchain, and so on. So the step one, I think, for investors is to get a basic understanding of these asset classes and not speculate just basis without any basis. So that's one. The second is to understand the concept of asset allocation, similar to like a balanced meal that we have. We need to have our proteins, fats, carbohydrate, vitamins, and not just only have salads or desserts, right? Third is to how to construct such a portfolio in practice using mutual funds and now index funds, ETFs, and so on, right? So that is step number one, just to kind of set the foundation. And second, now I believe in the environment that we are in, where the uncertainty is quite high and volatility is also expected to remain this year, I think a multi-asset allocation strategy is the ideal strategy to follow in this environment. You would have heard, most mutual fund houses, including Aditya Birla Mutual Fund, have launched their multi-asset allocation funds, which are quite suitable because they give exposure to different asset classes, including domestic and international equity, fixed income, commodities like gold and silver, as well as REITs and InvITs, right? So in this environment that we are in, where it's difficult to predict what can happen from day to day, it's ideal for investors to keep their life simple. Maybe they can just look at this multi-asset allocation fund, where not just the initial allocation, but the rebalancing, the monitoring and the rebalancing, as Dhirendra sir was mentioning, is done on a regular basis. So the investors don't need to worry about timing the markets. They can just start an SIP or invest a lump sum in this multi-asset allocation fund. And the regular monitoring and rebalancing is done by the portfolio managers, right? So those are the two steps I would recommend. Definitely take a look at this book, The Financial Independence Marathon. Is available on Amazon. And second, look at the multi-asset allocation funds that are available in the market.
Absolutely. Well, investing is, in a sense, a marathon. So you have to really pace yourself to achieve that goal of winning that race of life. On that note, we'll conclude this first session of the Nivesh Mahakumbh, this first panel on the topic of the edge of asset allocation, where all of our speakers have wonderfully outlined the dynamics at play when we look at these four asset classes, whether it's equity, debt, gold, or real estate. And the message which has come out from our speakers is that asset allocation is the cornerstone of successful investments. And there's no really a one-size-fits-all formula. And understanding the significance of each asset class and the value that it adds to your portfolio, that goes a long way in ensuring diversification objectives do not fall by the wayside. On that note, I'd like to thank all of our speakers, Piyush, Gurmeet, Dhirendra, and Vinod. Thank you so much for joining us on this panel to share your insights.
An investor education and awareness initiative of Aditya Birla Sun Life Mutual Fund. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.